Hello, everyone, and thank you for joining us for our latest session of our ongoing webinar series. This one is called End of Year Tax Strategies for Financial Success. My name is Tom Bittinger. I'm with the marketing department here at Wealth Enhancement. And before we begin, I just want to jump into a few quick housekeeping items. As always, there will be a Q&A session at the end of the presentation. We're going to try to keep this one short, so not sure how many questions we'll be able to get to, but anything we don't get to, we will have your advisor reach out to you. So feel free to continue to submit questions using the questions pane on your GoToWebinar menu. And then also, we will be recording the session and a replay will be sent out to you. So either look for that tomorrow or early next week. We'll get something out to you in your inbox. Moving on, so today's presenter is Michael Goff. He's a regional vice president with our new client development team. He's based out of Brentwood, Tennessee. And even though he's a more recent member of the Wealth Enhancement team, he's got a lot of experience as an executive coach and consultant for financial advisors and practice owners. And again, Michael, we got a lot to get into, so I'm going to hand it off to you.
Wonderful. Well, thank you, Tom. And yeah, everyone, my name is Michael Goff. I reside in Brentwood, Tennessee, which is near Franklin, kind of a popular town nowadays, south of Nashville. I have two main things that drive me today, and that is my wife and my daughter. I have a 3.5-year-old daughter. Every morning she comes and runs into my bedroom and wakes me up and says, "Daddy, can we play? Can we color?" And I never dreamt in a million years that someone interrupting my sleep would lead to so many smiles and so much happiness. So that's purpose and drive number one. And number two, the reason I'm here today is I truly enjoy pouring into others and sharing strategies that might be able to enhance your chance at financial success that maybe you've thought of, or maybe you need to dive a little bit deeper into. And that comes from something that hits a little closer to home as well, because my mother and father worked with an advisor for many years, and then they found Wealth Enhancement Group, and they worked with a Wealth Enhancement advisor, and that advisor helped change their plan and their legacy to leave behind. So I saw firsthand the impact of how strategic financial planning and tax strategies can impact someone's life. And my goal today is, time is one of those things you don't get back. So if I can give you the greatest return on your time, your most valuable asset, even if it's just one tip that you can take away to your advisor that you're currently working with and say, "Hey, will this work in my situation?" Or maybe you don't have an advisor and you're watching this presentation and you go, I haven't thought about that. I need to get a hold of someone. We would love to be able to be that conduit for you. So let's dive in. Benefits of strategic tax planning. Now, I do want to preface this. We've all heard of the adage, drive for show, putt for dough. And oftentimes when people come to us and they ask about how to better their financial situation, they want to look into the sexy and fun ideas like alternatives and private equity, different things of that nature, option strategies. And those are all fine and dandy if they make sense for where you are. But we truly believe a sound financial plan, along with strategic tax planning, that's your putting for dough. That's your foundation to financial success in the future. So it might not be the sexiest conversation on the planet, but we're going to dive into a couple ways that we can help you. So in this line of work, we often encounter a belief from clients that tax planning only makes sense if your income has increased significantly over the past year. Now, certainly that's one reason to revisit your tax plan. After all, high income earners, year-end tax planning, it's an ideal way to help you reduce your tax liability so you can minimize that tax bill at the end of the year. But it's also super important to consider this if your income has gone down for whatever reason. Maybe it's a job change, maybe you're in sales, maybe it's just market conditions. But strategic planning can also help you mitigate your losses so that you can preserve your savings and potentially take advantage of some lower income years to rebalance your portfolio. And we're going to touch in more detail on that later. Either way, getting into the habit of reviewing your financial situation, your tax situation at the end of the year, is a great way to ensure, again, your financial success as those earnings shift over time. So before we dive in, let's take a moment to review the basics. Now, I'm sure you know tax planning for individuals generally starts with understanding your tax bracket. So I want you to actually look here at the row going left to right. Now you need to decide, how are we going to file? Are you a single filer, married and filing jointly, married and filing separately, or head of household? Once we have that, we look at the column on the left, and that's going to be our tax bracket ranges. That's going to be determined on your total income. For example, let's say you're a single guy earning $90,000 this year. That's going to put you in that 22% tax bracket. Alternatively, if you're married and filing jointly, and let's say both of you are in sales and you're crushing it this year, and you're going to approximately earn $550,000, that's going to have you in that 35% tax bracket. These percentages make a huge difference when it comes to calculating your annual tax bill, and explains why tax brackets are so important and why it's critical for you to review your tax plan each year, particularly if your tax bracket changes. So we're going to cover 3 different strategies today based on where you're sitting this year and this season of life, starting with if your income is higher than normal. So if you find yourself in a higher bracket for 2025, one of the best ways to reduce the taxes you will owe, is by maximizing contributions to tax deferred accounts like your traditional IRA or your 401k. Even better if you're in a company that matches your 401k. We call that free money. This has a range of benefits. First, contributions to these retirement accounts aren't taxed, and the amount you contribute is deducted from your taxable income. So that means by maximizing your contributions to these accounts, you may be able to lower your taxable income sufficiently to fall into a lower tax bracket. I want to give you just a real life example. I was talking with a friend the other day who was in the 22% tax bracket. If you think about the slide we looked at before, he was earning around $90,000 a year. And he said, Mike, I got a promotion. They're going to give me $130,000 plus commissions. And I said, congratulations, I'm so happy for you. And I've been in this industry too long, because my mindset immediately went to, oh my goodness, he's in a higher tax bracket now, and he's going to be hit with a fairly substantial tax bill. So the first thing I said was, hey friend, have you thought about, because this company has a 401k, what if you maximize, as you can see on the slide, your $23,500 contribution to that company's 401k? Because generically speaking, in doing so, you can minimize that tax bill and get close to falling into the 22% tax bracket, which could save thousands of dollars potentially in his tax bill. So anyways, that's just a real world example where you can look at this slide here and go, do I have a 401k available to me? Am I maxing out my traditional IRA for $7,000? These are ways to sufficiently lower yourself potentially into another tax bracket. Also, you're going to see in the middle here the catch-up contributions. Now, if you're 50 and older, you might be able to capitalize on that, which would further reduce your tax bill. In the example of the 401k, an additional $7,500. And I know this is going to sound crazy, but if you're over 60, you may be able to make super catch-up contributions. Now, it sounds like a superhero or a game, but it's not. It's very complicated. And even with all these slides that we have here with the Roth, the traditional IRAs, the HSAs, it's nuanced, because depending on how much you earn in a calendar year will dictate if you can make full contributions to those. So the key here is, if you're working with an advisor, go talk to them and find out which one of these, if any, are available to you. All right, moving on. Another fun way that you could potentially reduce your taxable income by the end of the year is doing something called tax loss harvesting. At a basic level, tax loss harvesting allows you to offset some of those realized capital gains with realized capital losses. For instance, if you sold investments at a loss, you could use those losses to reduce those capital gains taxes that you would have otherwise owed on investments you sold at a profit. I'll give you another real world example. I'm going to tell on myself here. Back in the day, I purchased GoPro when it was an IPO. Me and all my friends utilized the equipment, and we thought it was going to be a great stock to buy. Well, if any of you know, GoPro has done much of nothing, and I am sitting at a loss. So in a generic example again, if I had a really high income year this year, I could sell my GoPro losses and use those to help offset some of the capital gains. So also, even if you didn't realize any capital gains this year, you can still use tax loss harvesting to offset up to $3,000 of your ordinary income, as well as you can also carry forward any investment losses you realize this year to offset gains in a future year. That's partly what makes tax loss harvesting such a great long-term strategy for high income earners. All right, this is one of my favorite slides. If you are charitably inclined, you're going to see 3 out of 4 options here that can help you maximize or accelerate your tax deductions. So you have a wide range of deductions available to you. We're going to focus on some of these underutilized areas that can help you during your highest income earning years. Number 1, donor advised fund, or we like to call it DAF for short. The beauty of contributing to a donor advised fund, it actually immediately triggers a tax deduction while allowing you to direct the charity on how you want to spend your donation after the money has had time to grow in the fund. I call that being able to have your hands on the steering wheel, so to speak. So that's a great option for you if you're charitably inclined. Also, another consideration, if you prepay your state income or levied property income taxes or property taxes, if you plan to itemize those deductions, you can actually prepay those taxes this year, which would make you eligible to deduct them from your current year's income. Third and fourth here, we're going back to being charitably inclined. We have optimizing charitable donations. This is where you could actually donate appreciated assets. So think NVIDIA stock. Maybe you've had that and it's went to the moon over the past few years. You know that's going to be a big capital gains bill. You could actually donate that stock as a cash donation and generally avoid paying capital gains tax while actually contributing and making a real world impact to a charity that matters to you. And finally here, QCDs, otherwise known as qualified charitable distributions. Starting at age 70 and a half, you can actually route distributions from your retirement accounts directly linked to qualified charities using QCDs. This strategy can help you keep your income down, which is particularly helpful once those RMDs or required minimum distributions kick in. All right, minimizing the net investment income tax. This is another way. If you haven't heard of it, don't feel bad. This is another way that the government wants to get theirs, their 3.8% tax on investment earnings over your modified adjusted gross income. Now, this is complicated. There's a lot of calculations that comes into this. I'll give you the basics here. If you're a single filer, your MAGI threshold in 2025 is $200,000. And if you're married filing jointly, that number is $250,000. The biggest takeaway I want you to walk away with from this slide is if you think you're pushing close to those numbers, make sure to ask your advisor about how you could potentially minimize your net investment income tax. So we're not giving even more money away. I like to say I love being patriotic. I just don't want to be too patriotic. All right, as promised, let's move on to what if you're in a situation where your income is lower than normal this year. Doesn't mean it's all bad. There are ways you can maximize some tax strategies here to help you as well. So we're going to be looking at 3 different strategies as you'll see on the screen. Deferring your tax deductions, potentially rebalancing your portfolio, and considering a Roth conversion. Number 1 here, how do we or can you defer your itemized tax deductions? The idea here is to avoid tax deductions you don't necessarily need. So when you file your taxes for the year, you're still going to claim your standard deduction. If your income is lower though, it may make sense to push off any deductions you have control over until a year later when your income is higher so that you can make the most of those deductions. Second strategy is what we call rebalancing your portfolio. I think this is an amazing strategy to think about or consider. Talk to your advisor about if you're sitting in this seat. When we talk about a balanced portfolio, what we're actually referring to is the mix of different asset classes within your investment portfolio. Typically, that balance will reflect your personal investment goals and your risk tolerances. Sometimes, though, based on market performance, your portfolio balance can become skewed, resulting in an asset mix that doesn't match where your tolerance is. So rebalancing involves bringing your portfolio holdings back to their ideal ratios, which entails buying and selling some of your assets. Now, if you sell during a high income year, the additional gains you earn could potentially push you into a higher tax bracket and result in additional capital gains, which most of us don't want. And for this reason, that's why during your low income earning years or lower income years, it presents a great opportunity for that portfolio balancing strategy or portfolio rebalancing strategy. Looking at the chart here, as you can see, if you're a single filer whose income fell below $48,000 this year, you could potentially sell some of your assets without owing any, yes, I said any, capital gains taxes at all. And if you're married filing jointly, you would still owe 0% capital gains tax if your income fell below $96,000. So again, a lot of numbers here, a lot of rows, a lot of columns, a lot of things to think about, but that's why going to your tax professional or your advisor is so important to look at these strategies and see, again, if they make sense for you and where you're at in your plan. Something that's very popular nowadays, we have a lot of conversations around this, is Roth conversions. And simply put, a Roth conversion involves transferring some of your retirement funds from a traditional IRA or 401k into a Roth IRA. Now, one of the main advantages of holding funds in a Roth account is that you won't pay taxes when you finally withdraw those funds during retirement. Why? Because you're paying taxes up front when you move your money from a tax deferred retirement account into a Roth account. This is one reason why it makes sense to execute a Roth conversion during lower income years, because in theory, you'll pay less taxes when you're moving those funds over to your Roth account. This slide again, Roth conversions, they're amazing if they make sense for you. So again, I want to reiterate, if you're in a lower income earning year, there's a potential opportunity for you to do a Roth. Again, your income drops, you may pay less tax on conversions. Here's where it gets tricky. If you can afford to pay those taxes now, because again, you're in a lower income earning year, but if you can afford to take that hit to pay the taxes now when transferring to a Roth, you could reduce your future tax burden because that future growth and those withdrawals from the Roth will be tax-free. Another thing to think about, timing matters. Roth conversions are very popular and for good reason, but planning your conversions around your income level can make a huge difference in your portfolio in the long run. And remember, despite the potential advantages of a Roth, this strategy isn't for everyone. So it's important, again, speak with your financial advisor to make sure this strategy makes sense for you moving forward. All right, lastly, we're going to talk about strategy number 3. These strategies are going to cover if you receive income through a bonus, equity, or some other form of non-cash compensation. Now, there can be numerous approaches you might be able to take. We're going to look at 3 quick strategies again, just to really get your wheels spinning here. The ability to create a multi-year plan to balance the tax impact of exercising stock options. That's number 1. Number 2, using a net unrealized appreciation strategy, or NAU, if you receive company stock from your employer. And then number 3, deferring bonuses and income during those higher income earning years. So let's dive into those a little bit. So number one, this applies to you if you've been issued stock options. Now, the key, number one, is differentiating what stock options have you actually been issued. Are they statutory stock options like incentive stock or stock from employee stock purchase plan, otherwise known as ESPP, or are they non-qualified stock options? You'll hear that oftentimes called NQSOs. These two classes of options have different tax implications. Like everything else we've talked about, it's always nuance here. With statutory stock options, you can generally qualify for more favorable long-term capital gains rate if you hold your stock without selling it for a certain prescribed amount of time. With non-qualified stock options, however, the gain you earn on the sale of your options will be taxable as regular income, which attracts a higher tax rate. And for that reason, it's important to create that multi-year plan that we talked about to help balance cash flow and the tax implications associated with exercising these different options. Quick example, during a high income year, for instance, you may not want to exercise your non-qualified stock options if you don't have to. Conversely, a lower income year may be a good time to exercise these options. Again, depends on your strategy and your overall plan. All right, second strategy we're going to cover here involves the tax treatment that typically applies to company stock that your employer may issue you through that ESPP or a 401k. For tax purposes, these have two parts. You have your cost basis, or what you paid for the stock, and the appreciation, how much it goes up from what you bought it for or purchased it for. Now, normally, distributions from 401ks are taxed as regular income, which means you either pay whatever your tax rate is that you fall into based on the tax bracket that we referred to earlier today. If you follow the NUA rules, you still pay regular tax on the cost basis of your shares, but you may be able to pay more favorable capital gains tax rate on your stock's appreciation. One critical thing to note here, specifically, an NUA transaction can only take place after a qualifying event, which are either being 59 and a half or over, no longer working for the said employer, or you just retired. And in this case as well, it's important, as always, speak with your financial advisor to see if any of these strategies make sense for you. All right, the final tax planning approach we'll cover today is something called deferred compensation strategy. This is typically offered to employees who are in a higher tax bracket, executives, CEOs. In essence, it allows you to defer a portion of your income or bonuses to a future year, presumably when you're in a lower tax bracket. If your employer doesn't currently have a deferred compensation plan in place, but you think you can benefit from one, it may be worthwhile to bring it up. Speak to your employer about setting one up, potentially positive for you. On the flip side, there are some risks associated with deferring your compensation. Again, nuanced, very technical here. So speak with your financial advisor, or if you don't have one, we would love to have a conversation with you. All right, let's wrap this up in a big, pretty bow. We've covered a lot of strategies. Again, this wasn't meant to be a PhD level course on tax and tax strategy, more just scratching the surface, helping you understand different ideas to consider or think about. That being said, I hope I've given you some new ways to consider some end of the year tax planning and how considering your taxes as you efficiently structure your finances and investments in both higher income and lower income years. Again, a strong financial plan with proper tax strategies is going to be one of the greatest ways you set yourself up for financial success in the future. If you'd like to delve any deeper in any of these topics, please don't hesitate to check out our blog or YouTube channel.
All right, well, jumping in, it looks like we've got we got some time for a couple questions here. So first one on the list. Can you confirm or deny that there are no tax strategies that make sense for me to transfer money from my IRA to my Roth IRA?
Confirm nor deny. I love that question. Thank you for that. I feel like I'm sitting on the lawyer seat right now. I'll preface this with, just like we have in the rest of the webinar here today, It's all nuanced depending on what is your overall financial plan, what are your goals, where are you at currently in the bigger picture. But one thing to potentially consider would be a Roth conversion. That would be the number one thing that might be able to save you money in taxes later on, help you with those RMDs further into retirement. But again, all comes back to where are you at currently? How does that fit into your greater financial plan, and do the numbers make sense long term for you?
All right. Probably going to be the last question we got. I don't want to take too much of everyone's time. What are some tax strategies for newly retired people?
Tax strategies for newly retired people. Well, this kind of segues potentially into that Roth conversion conversation again. And here's what I would tell you. The number one thing with Roth conversions, like we talked about on the webinar today, they could potentially save you long term. If you have a long life expectancy, you're going to live a long time, and you want to defer or pay the taxes now, that way you can get those tax-free withdrawals later, it might make sense for you. Here's my recommendation. Get with your current advisor, and if you don't have one, we would welcome you to come to our office or meet virtually with one of our advisors. And here's what we'll do for you. We can actually run your numbers and do a Roth conversion analysis for free on us, and you'll actually see where the intersecting lines come out and make sense on if doing a Roth conversion, again, makes sense for you from a data standpoint or a number standpoint or not.
All right, excellent. Thank you so much, Michael. As you mentioned, we got a lot of information on our blog, on our YouTube channel. So if you want to learn any more about any of this stuff, I encourage you to check all that stuff out. Again, I apologize for not getting to more questions, but your advisor or someone with Wealth Enhancement will reach out to you if you did submit a question. And again, this has been recorded. So check your inbox in the coming days, or check our YouTube channel, check into that other stuff. We'll definitely have this replay available to you, so you can check out anything that you missed. Michael, thanks again for being with us, and we look forward to seeing you all next time.
Awesome. Thanks, Tom, and thank you everyone again for joining us. These are highly complex topics with tons of nuance, and if you're sitting here watching this going, I really love the sound of those strategies, but I don't know what my next steps are. Or maybe you've been a do-it-yourselfer for the past 20 years of your life, and you're gearing up for retirement, and you say, man, I'd really love to just fish and hang out with my wife and grandkids and take my hands off the wheel for a little bit with a trusted advisor who's an expert in this kind of stuff. I highly encourage you, set a meeting, come talk to us. There's no obligation, it's completely free. Think about it as a business opportunity with no downside. You can sit down with an advisor, we can comb over your statements and your plans and figure out where are you and how we can best help you moving forward. Again, that's my greatest encouragement to you. Would love to see you in the future. Have a great day, everyone.